Avoiding taxes often costs more than paying them.
Moving forward with the Dekker team. Moving forward together with the Dekker team.
We're honored that for over 35 years, we've been able to come alongside you, not only selling, buying, and investing in real estate over 3,117 times, coming alongside you to build your fund, build your fitness, build your finances, and even strengthen, heal, and flourish inside relationship.
Mm-hmm.
Investors.
Yes.
Investors sometimes get this thing wrong.
Yeah,
We've been there.
There's a big difference, Yetta, between avoiding taxes, which now affects your decision making, and minimizing or efficiency in taxes. Right?
Right.
They're two different things.
They are.
And even if you're just earning an income, you're a self-employed person and you avoid paying taxes, that will bite you.
That's
right?
that's gonna cost you more than just pay them.
That's right. But what we're really talking about is real estate investments, right? And first of all, in your principal residence, the one you live in, your permanent residence, there is no capital gain on that. So that's a beautiful tax efficient. You're not avoiding taxes because there are no taxes on that.
Right.
But now we're talking about other investments, and we talked in segment B about the investor that decided not to sell an underperforming property because there would be some capital gains on it. That could cost them long term, because when you move into an effective property and now 20 years down the road, the difference is magnified so much that the original amount of capital gains tax is negligible compared to the growth that you've had by moving into a better property.
Or a property that performs better. It may not be a better house or a better multifamily, or it may not need less maintenance. It may not be better in all your facets, and it is a more effective property for the purpose of investing.
Right. Now, we talked briefly about tax efficiency. So, I've had many clients that have sold a piece of land. They've had it for 20 years or 30 years, or some of them it was given to them by a parent, and now it's got a lot of capital gains. But then I said, well, have you been deducting the taxes on the property that you've paid for those last 20 years? They said, no. Okay, well, go to your accountant and see what amount of those property taxes that you paid over 20 years you can write off against the capital gain, right? That's a cost of carrying that property. The cost of your accounting, the cost of the legal, the cost of the real estate, all of that comes off before capital gains. And then there are ways, like one person, they're not an elderly person, and I said, well, why don't you take that capital gains money? Let's say, again, that same example, right? 200 to 400. You got $200,000, but you're going to be taxed on 100,000 because it's capital gains. You take that 100,000, if you've got room, drop it in your RSP. Now the taxes are gone.
For now.
The capital gains are gone until you remove it.
Right.
Later, you remove it slowly as you retire or whatever. It's giving you room. It's giving you that money that you would have paid in taxes is now sitting in an RSP.
Increasing.
Growing and increasing. And yes, you'll have to pay taxes on it eventually. But your growth is happening on money that the government would have had and you wouldn't have been able to. So that's one way.
And keep remembering, I can't drive this point home enough, you don't pay capital gains until you go to sell it. So it keeps growing and multiplying exponentially without any money coming off, without taxes being paid.
That's why
so therefore, it grows much quicker than any other type of investment, all things being equal. And even if things aren't unequal or equal, because you don't pay tax and then get to grow what's left. Pay tax and grow what's left. Whereas with interest and pretty much every other investment, you pay tax and then you help grow what's left. So real estate functions so differently. And if this was confusing, like really it's time for a clarity call, because in the clarity call, we can understand from you what you know, what you don't know, where you have misunderstandings, where you maybe have some misconceptions, or where you just don't have any clarity whatsoever.
Mm-hmm. And really what I get to do with many people is open their eyes to the questions they should be asking their accountant. Because we are not certified accountants.
No.
We're not CAs. I understand a lot of it, and I direct them to go ask your accountant this, ask them that. Maybe there's some tax efficiencies there that the accountant knows about, right? And look at different things, because capital gains isn't just on real estate. It's on if you're buying stocks and then you sell them and they sold for more than you paid for them. That's capital gains. Or maybe you've got capital losses that you can carry forward. Maybe you did buy some stocks and they went down and you sold them and they weren't inside a shelter like a TFSA or an RSP. And that's a capital loss. And you can put that on the books. And then when you do have a capital gain selling some real estate, they offset. So you don't have as much money going into the capital gains portion.
Right. So it's not as straightforward as we want it to be or we make it sound. No, it's not.
Well, there are complexity, and I always say paying a great accountant is money well spent, because it's an investment in your tax efficiency and not overpaying in tax. Taxes are good. Taxes are what build the roads and, the social services and all the different things that we come to expect as Canadians. And there's no point in overpaying taxes more than you need. Like if, we talked about that interest, right? That it's taxed at the highest. Well, drop that in your TFSA, your tax-free savings account, if you have room in there. Right now, if you haven't put any money into a tax-free savings account, you probably have about $100,000 worth of room there that you can put investments in, not real estate, but mutual funds, bonds, GICs, whatever, and earn tax-free money.
Which is a great place to put interest-bearing things in.
Yes, You got it. Yeah, so the Canadian tax system is designed, of course, to tax the wealthy a little heavier, but there are things that the wealthy can do that will save them tax money, right? And you mentioned the clarity call. How are they going to get a clarity call?
Go to dekkerteam.com. It's that easy. Just scroll down till you see the spot that says schedule my clarity call at dekkerteam.com. That easy.
Yeah, so I'm going to ask our listeners, what might growth look like if tax stopped being the villain in your story? So many people, I'd say, they don't want to earn money because they're going to have to pay tax. Well, I think it's a good problem to have to pay tax.
Exactly.
Because it means you've made money, right? And Mark Zuckerberg, what did Mark say?
He said that the biggest risk is not taking any risk.
Ooh, the biggest risk is not taking any risk. Wow. So don't let tax fear decide your future. Let clarity and alignment lead it instead. And we're glad you joined us on Life's Inside Track, because when we move forward together we've got this.
Moving forward with the Dekker team. Moving forward together with the Dekker team.